Hello ladies and gentlemen, and welcome to another video. Today we're going to talk about bonds and discover exactly what bonds are, how you get paid, and if it's worth investing in bonds. So let's get going with the video. Before we get started, let's make sure you like this video and hit that subscribe button to make sure that you don't miss anything as we go through this financial education journey together. So what is a bond? A bond, which is sometimes called fixed income, is essentially an IOU from a country or a company. That's ultimately as simple as it is. So thanks for watching the video and see you next time. Only joking, it's a bit more complicated than that, but ultimately when we boil it down to its simplest form, a bond is an IOU. In the same way in which you'd lend money to a friend or family member, you're doing exactly the same. However, this time you lend it to a country or a company. When you buy a bond, you are lending money to whoever's issuing the bond. So in the case of a country, you are lending money to the country, and these are called government bonds. But when you are lending money to a company, these are called corporate bonds. So why do governments and companies issue bonds? The main reason in which countries or companies will issue bonds is to raise money to do something which they can't afford with the money that they have at the moment. In the same way in which an individual will go to a bank to get a loan to pay for a car or a house, companies and countries do exactly the same thing. The money raised from issuing bonds can be used from anything from roads and bridges to funding wars, or to buy specialist equipment that a company needs. So instead of going to the bank and asking for money, companies and governments go to investors, making the investors the lenders. This is because it's often impractical for banks to lend the billions of dollars, which is normally what is raised when companies and governments issue bonds. This is because the banks can't take that much risk to lend against one company or one government. And it also enables issuers of bonds to be more flexible in the length of time in which they borrow the money, and also the rate of interest that they pay. A very important property of bonds is the fact that they are rated by these companies called rating agencies, whose only job is to analyse bonds and determine its creditworthiness and determine how safe these bonds are. And by safe, I mean how likely you are to get your money back when you invest. These rating agencies assign ratings to borrowers, and the higher the rating, the more trustworthy it is. This is the same way in when you have a friend who you trust and you lend money to, knowing that they'll pay you back. However, you also have a friend who, when you give them money, when you want it back, they'll ignore your calls, ignore your texts, even though you've seen them go on holiday. These rating agencies assign two categories, normally investment and junk. Investment is assigned to the highest quality borrowers. So in government bonds, these are assigned to the US, Germany and UK. And for corporate bonds, these are the best companies such as Microsoft and Johnson & Johnson, as these are seen as safer investments and you're more likely to get your money back. Junk bonds or high yield bonds carry a higher amount of risk and therefore less likelihood of being paid back. This is normally assigned to countries who have more political instability and companies who are not as well established or as profitable. Before we go any further, there's a little bit of financial jargon that we need to cover just so that you can understand bonds just that little bit better. The first is rate, which is sometimes called yield, and this is the main way that an investor gets paid. The rate means the percent of interest that an investor will get annually. This is normally fixed at the point of purchase, hence the reason it is called fixed income. This is the amount which you are charging for lending your money. This is the same way in which credit card companies and banks charge you money for borrowing money from them. The next is duration to maturity. This is the length of time in which a borrower wants to borrow their money. This can be anything from a few months to 100 years in the case of some government bonds. For example, if I buy a bond for 5 years yielding 5% for £100, it means that I have paid £100 for a bond, which will pay me 5%, so £5 per year for 5 years. And finally is default. Default is when the company or country doesn't pay what it has promised to pay. So in the previous example, I've bought a 5-year bond returning 5% per year. Default could mean that I'm not paid my full 5% per year, or I'm not returned my £100 at the end of the 5 years. This leads me on to how you get paid for holding bonds. Well, the main way you get paid from bonds is the interest. The interest that is paid depends on the creditworthiness of the borrower. Simply put, the less creditworthy a borrower is, the more interest that is paid. That is because investors want to receive a higher rate of interest for a greater amount of risk that they won't have their money returned to them in the future. Another way that investors can make money from bonds is they can sell them when the price goes up. This is similar to the way that you can invest in stocks. The way that bonds work, the more expensive it gets, the rate goes down. And the cheaper it gets, the rate goes up. This can be quite confusing to understand. So if we go back to our example where I bought the bond for £100, yielding 5%, that I bought this bond, and then the next day, it is now trading at a yield of 4%. This doesn't mean that I will receive less money. I will still receive my £5 per year. However, the price of the bond has gone up because that 5% now represents 4% of the value of the bond. So now the value of the bond has moved from £100 to £125. In the real world, returns like this are unlikely. However, I want to highlight to you how professional investors who trade millions can also make money off bonds. The real advantage of bonds over stocks is the promise of return, that you expect to receive your interest payment each and every year, followed by the amount of money that you paid at the end of the bond. This makes them less risky than other assets, as they're like a higher rate paying savings account, but the money is locked away for a certain amount of time. Bonds also provide diversification to your portfolio. This means that they spread out the risk, so you're not reliant on any one form of investment for your returns or your income. This is very similar to the advice of personal finance, which say you shouldn't rely on one source of income. However, the biggest downside to bonds is the fact that they provide lower returns than other financial assets such as stocks and real estate. Data collected from NYU shows that $100 that was invested in 1928 into US Treasury bills, which are the safest of bonds, would have returned just over $8,000. Not necessarily bad for doing nothing with $100 over the last 90 years. But if that money was invested in the stock market, more specifically the S&P 500, which is the stock market of American companies, that would have returned $500,000. The main reason why there's such a difference in the amount of money and the returns from these two investments is that bondholders do not get to share in the value creation in the company, the same way in which stockholders do. Bonds are a great indicator for the health of a company and can be used in company analysis, especially the ratings which are provided by the rating agencies. And finally, bonds are a great source of guaranteed income and can be used really effectively depending on your stage of life. And these are particularly useful for people who are close to retirement, as they can maintain their standard of lifestyle when they lose their primary source of income. I hope this has provided you a good overview of how bonds work and how they are used in a portfolio setting. And maybe this might be particularly useful for you if you are approaching retirement. However, if you're decades from retirement, bonds may not be for you, as the lower returns compared to other investments may not enable you to achieve your financial goals. Please let me know in the comments section below your thoughts on bonds and whether you'd now consider using them in your portfolio. Thanks for watching the video, and please give it a like. And also make sure you subscribe so you don't miss out on any further videos.